Course of Finance, Academy of Finance, Level License, Lesson Income Statement, Key Things to Know, by Isabelle Dermant-Ferrer. In this lesson, we will see revenues, expenses, the matching principle, accrual basis of accounting, format of the income statement, terms related to the income statement, cash basis versus accrual basis. Let's see the first point, revenues. Revenues provide goods or services to customers in return for an asset, cash. The revenue principle, 4 criteria that must be met for revenue to be recognized. 1. Delivery of goods has occurred or a service has been rendered. 2. Persuasive evidence of arrangement for customer payment. 3. The price is fixed and determinable. 4. Collection is reasonably assured. Revenue is not recognized when cash is received. It is recognized when earned. Point 2. Expenses. Expenses use an asset to generate revenues incurred when 1. An asset is used up. 2. A service is provided to the company that must be paid for. Expenses are recognized when incurred, not when they are paid. Recognize means to record and report in the financial statements. Point 3. The matching principle. Expenses incurred to generate revenues must be recognized in the same period as a revenue. Revenues are recorded when earned, and expenses are recorded when incurred to produce the revenues. Examples. Wages and salary expense is recorded for the period the employees work to produce revenues. Depreciation expense is recorded for the period the long-term asset is used to produce revenues. Interest expense is recorded for the period the money is used to produce revenues. Utility expense is recorded for the period the utilities are used to produce revenues. Bad debt expense is recorded in the period the sale occurred. Point 4. Accrual basis of accounting. Revenues are recorded when earned and expenses are recorded when incurred. Warning: when the cash is received or paid does not matter. Point 5. Format of the income statement. We will see format for US GAAP, format for IFRS, and how to analyze the income statement. First of all, we will see the format for US GAAP. There are 2 presentations in US GAAP: the single-step income statement, the multi-step income statement. It is a presentation by function. First of all, let's see the single-step income statement. For a period of time, list all revenues and subtotal, and list all expenses and subtotal. Sales, interest income, rent income equals to total revenues. Cost of goods sold, selling expenses, administrative expenses, interest expense, rent expense equals to total expenses. Net income equals to total revenues minus total expenses. Let's see the second presentation, the multi-step income statement. the presentation by function. For a period of time, you have sales minus cost of goods sold equals to gross profit minus operating expenses, that is general and administrative, selling, research and development, restructuring, equals to operating income, plus minus other revenues and expenses, interest income or expense, rent income, unusual gains and losses, realized, unrealized gains, losses on investments, gain, loss on sale of an asset, equals to income before taxes minus tax expense, equals to income from continuing operations plus minus discontinued operations plus minus extraordinary items equals to net income. Let's see yet the format for IFRS. In IFRS, you can present the operating income in two different ways. We will see presentation of the operating income by function, and after we will see the presentation of the operating income by nature. First of all, let's see the presentation of the operating income by function. So, the presentation by function, you have profit or loss section, revenue or sales, minus cost of goods sold, equals to gross profit, minus operating expenses, that is, minus distribution costs, minus administrative expenses, minus other operating expenses, equals to results of operating activities, that is operating income. You can see that this presentation is very close to that used in US GAAP. Second presentation, the presentation of the operating income by nature. Presentation by nature. Profit or loss section, revenue, sales, minus changes in inventories of finished goods and work in progress, minus work performed by the entity and capitalized, minus other operating income, minus raw materials and consumables used, minus employee benefits expense, minus depreciation and amortization expense, minus other operating expenses, equals to results of operating activities, that is operating income. The second part of the income statement is identical whatever the presentation chosen. You have from the operating income plus other finance income minus other finance expenses equals to results of financing activities. Operating income plus or minus results of financing activities equals to profit before tax minus income tax or tax expense equals to profit for the year or net income. In conclusion, we can say that you have the operating income presented by function or by nature, and the second part of the net income. You can see the example in the next video. Now let's see how to analyze the income statement. If you want to analyze the income statement, you can break it down into intermediate balances. That is for a period of time, sales, production, value added, EBITDA, earnings before interest, taxes, depreciation, amortization, minus depreciation and amortization equals to EBIT, earnings before interest and taxes, or it is the same as operating profit. Net financial expense, it's B. Operating profit minus net financial expense equals to profit before tax and non-recurring items equals to net income or net profit or loss. The next point deals with terms related to the income statement. We will explain each term of the income statement: sales, cost of goods sold, gross profit. It's the sales price less the cost to buy or manufacture the goods sold. This is the profit made from selling inventory only. This profit is used to pay operating expenses. Operating expenses directly related to day-to-day business operations. Related to 1. Selling, that is, sales employees, marketing, advertising. 2. Administrative, that is, expenses to run the organization. 3. Research and development, that is, to develop new products. 4. Restructuring of operations, to reduce future expenses. Operating income, sales less cost of goods sold, less operating expenses. This is what is earned from day-to-day business that is expected to continue in the future as the business continues. Plus minus other revenues and expenses, the result of a transaction that is not part of your primary day-to-day business. Interest income or expense. Interest income earned from excess cash, not your primary business. Interest expense, a cost of borrowing money. Rent income, earned from leasing excess space, not your primary business. Unusual gains and losses, realized, unrealized gains, losses on investments. Gains, losses resulting from selling assets you no longer use, or disposal or destruction of an asset. Gain, loss on sale of an asset. Dividend income earned from investing excess cash when investing is not your primary business, equals to income before taxes. Income before taxes, tax expense, reported separately, not an expense that management can control since it is government mandated. Income from continuing operations, an indication of income that can be earned in future years, used for trend analysis. Discontinued operations, selling or disposing of a major part of the business. Product line, geographic area. Extraordinary items, unusual and infrequent, not expected to happen again. Net income, total earnings of the company for this period. And let's see the last point, cash basis, versus accrual basis. Cash basis. In a cash basis, revenues are recorded when cash is received for providing goods or services. Expenses are recorded when the cash is paid for something provided to the company. It can be an asset or a service. Accrual basis. In the accrual basis, revenues are recorded when earned. The goods or services are provided. Expenses are recorded when incurred. Use up an asset or a service was provided to the company. GAAP requires the accrual basis of accounting in order to follow the matching principle. That is, when cash is paid or received does not matter. This is the end of the lesson. You can continue by watching the next videos on examples, quizzes, and exercises.